Hey, what's up, guys? Welcome to the Stonks Maxxing Day 49. So, just finished lunch. Also, happy July 4th. But I'm gonna spend some time. I was meaning to read this memo by Howard Marks for a while now. So, having my day off today, thought I might give this a try. Alright, so let's just dive right into it, right? Sea change, a complete transformation or radical change of direction in attitude and goals. Two real sea changes. So 1969, it's 50 years ago. Okay, so this talks a little bit about Michael Milken and his, would it be a discovery, more so a new strategy of investing in high yield bonds when that didn't really happen? And then this also talks a little bit about the Nifty 50. So this was a portfolio of stocks, a group of 50 stocks that were considered to be the best in the world. So good that nothing bad could ever happen to them. Well, turns out that bad things could happen to them, and if you were to hold them from the period of 1969 to 1974, you pretty much lost all of your money. Prior to the inception of high-yield bond issuance, companies could only be acquired by larger firms, those that were able to pay with cash on hand to borrow large amounts of money and still retain their investment grade rating. Okay. Okay, so this kind of permeated into the invention of the private equity business. So this is where, prior to the inception of high yield bond issuance, having a non-investment grade rating was pretty much a death sentence, almost, for a lot of these issuers, because big money from pensions, endowments couldn't flow into these really risky or so-called risky investments. Even the most prudent investors should shy away from these types of securities. I think that's what the cultural norm was back then. And so with this invention of the high yield bond and the ability to actually make money and do it while controlling your risk, seem to have ended up in the expansion of private equity leveraged buyouts. I think that's the case here, right? However, the most aspect of this change didn't relate to high yield bonds or to private equity, but rather to the adoption of a new investor mentality. So now risk wasn't necessarily avoided, but rather considered relative to return and hopefully borne intelligently. Okay, so maybe this kind of adds to the argument here that previously people shied away from risk just for the sake of shying away from risk. But after the high yield bonds were mainstream and private equity as well, there was more of a risk reward consideration at play. There we go, sea change. Okay. Yeah, so I guess this is sea change number 1. So let's see. Sea changes are defined as structural changes to a way of doing / being, right? Okay, yeah. So Howard Marks has seen to see changes in his lifetime working in the finance industry. He started in 1969. So 1, a shift from thinking of only reducing the amount of risk to thinking about risk / return trade-offs. So instead of avoiding risk entirely, investors saw that they could be compensated for taking on even more risk, and so they entered more risky investments. So this is yeah, let's see. The outlook. Okay. At roughly the same time, big changes are underway in the macroeconomic world. I think it all started with the OPEC oil embargo of 1973 to 1974. Okay. So, seems like Howard Marks is saying that inflationary expectations are self-fulfilling, which is interesting, right? Because I would think that if people expected, maybe if people expect there to be more inflation, business owners are probably going to raise their prices, thinking that, hey, if other people are going to raise their prices, then we might as well raise prices as well. So maybe that's how it's self-fulfilling. Okay, so second sea change. So a shift from high inflation in the 1970s mid to late 1970s to restrictive monetary policy by the Fed. So restrictive monetary policy, I think, refers to raising interest rates in order to slow down the inflationary and business spending. So Paul Volcker as Fed chairman. Paul Volcker got appointed to Fed chair in 1979, right? I think this is interesting because Intel 880 was invented in 1974. So I think during this period, this is kind of right when the microcomputer revolution started taking off. And it's surprising to see that that was also the same time where inflation was at all-time highs. So trying to bring everything together, right? I think Microsoft was also started around this time somewhat. So that's, yeah, interesting to see. Okay. Then backed, then a 4 decades long decline in interest rates. %, what a period. So you get 10% each period. That means, I think if you do the rule of 72, right? 10% per year. So divide, let's say 70 by 10. So in just 7 years, you double your amount of money, right? And so that means in 14 years, you quadruple the amount of money. So you double the double. And then in 21 years, so let's say 40 divided by 7, that's close to 5. Maybe we could round up to 6 just to be optimistic, right? And then 7 squared, 2 to the 7th is 2 times 2 is 4 times 2 is 8. Right, 2 to the 3rd, 2 to the 4th, 2 to the 5th, 2 to the 6th, 64 extra money in the 40 years. So if I start today, I'm currently 22, I can 64x my money when I turn. Okay, so that means I need to invest a lot. Okay, yeah. All right, well, apparently Howard Marks thinks that the declining interest rates was the greatest role in the compounding of, so S&P 500, these are all large cap stocks. Yeah. So 3/4 over prime. I guess the prime rate that time was maybe the 10-year treasury yield, or maybe LIBOR. I think tonight, or not tonight, but these days it's secured overnight financing rate. I don't know who that's set by. But 3/4, I'd imagine that's like 75 basis points. So 0.75%. 0.01% is a single basis point. Oh, so it was a benchmark interest rate, predecessor of LIBOR. $2,000 basis points at 20%. Miraculous. Okay, so this is important to understand, right? A business's cost of capital. When I think of cost of capital, I think of opportunity cost, or maybe even the cost of borrowing. But I remember in Damodaran's book, he really thinks about opportunity cost. And when you're a business, you have really two sources of capital, so equity and debt. And with equity, because we had saw that S&P 500 index rose at a 10% compounded annual return for the past 40 years, the opportunity cost in investing in just the S&P itself is greater for equity compared to debts, where the opportunity cost is lower with declining interest rates. So with the cost of debt at 22.25%, I mean, yeah, that's a lot higher than the cost of equity of just 10%, but nowadays debt's around 5 to 7%, and the cost of equity for a single company, it's far more riskier than just the returns of the market, right? Usually you have betas that are greater than 1, maybe less than 1, so it's less risky than the market, and using the S&P 500 is a good proxy for that as well. They increase the fair value of assets. The theoretical value of an asset is defined as the discounted present value of its future cash flows, right? Thus, as interest rates fall, valuation parameters such as, so I'm surprised that cap rates on real estate decline, right? Because with cap rates, if I remember correctly, they're thought of as the net operating income. So kind of the income you receive from real estates, and then also you divide that by the market price. So maybe then the market price of real estate tends to fall with declining interest rates. Okay, so it pushes the price up, I guess. Yeah. Okay. Let me. They increase the fair value of assets. They reduce the prospective returns investors demand from investments they're considering, thereby increasing the prices they'll pay. This can be seen most directly in the bond market. Everybody knows if rates down, prices up, but it works out the investment world. Okay. Prospective returns from investments. I'd imagine they increase the prospective returns. Okay, I guess, yeah, this does make sense. So, okay, let's just kind of see where I am. So there's a decent amount. I'm gonna go use the bathroom real quick. Yeah. I think this would be an interesting example to go over. Okay, I'm back. You can make 10% of your ads, so buy it. You sold a 6%. Earning 10% on 3/4 of the capital. That's brought at 8%. We'll lever up the return to the other 1/4 as equity to 16%, right? So how would you think about doing that? So let's say you have 100%, so $100, right? So $75 is using debt. The other $25 is using equity, and he earns 10% on that entire investment. So he then gets $110, right? And $10 of 2.5 is, the 25 is 2.5, right? But I think he's, but he's getting $10. So, but he also has to pay 8%. But he has to pay 8% of that 75%. So 8% of $75 is, right, so 8% times 75, 8 times 5 is 40, 8 times 7 is 54. So I think that's 6. Yeah, $6. So he gets $4. $4 divided by 25. Is that 16%? I don't know. Just take a look. Four divided by 25. Yeah, 16. Okay. 19% level return. The interest rate on his floating rate debt declines over time. Now his fixed rate each that matures. Roll it over at 5%. Now the deal is a home run, 25% lever return, all else being equal. So that's interesting, right? Because turns out, or I don't know if it turns out, but David Swensen mentions that private equity, if you look at the entire universe of private equity managers, turns out that the median really underperforms. The median managers underperform the S&P 500, the 10.9%. But I guess 10.9% is looking from 1989 or 1983 all the way until 2023. But with private equity, I think pioneering portfolio management, so that was written in 2009, so about 13 years ago, 14 years ago. I guess in those 14 years, private equity returns have been a bit better. I don't know the exact return profile of the past 14 years of private equity, to be honest. But yeah, just wanted to mention that. So private equity managers, really not all of them, the median of them are not too great. Because your rate of travel over the ground is a sum of the speed at which you're walking plus the speed at which the walkway is moving. So that's used to describe the conveyor belt. That's what I think happened to investors over the last 40 years. So, Howard Marks is really adamant about to emphasize the importance of this decline in interest rates. Really emphasizes So the period between the end of the global financial crisis in late 2009 and the onset of the pandemic, right? Excuse me. Excuse me. Okay, so let me try to think about this here. Quantitative easing, you're purchasing bonds, right? And so if you're purchasing bonds, I think longer dated bonds as well, then that increases the price of those bonds. So thus you're driving the yields down for lower. So you're driving the yields lower for these longer maturity bonds. So you're effectively controlling the long rate of Alright, so you're kind of controlling your long rates, right? Yeah. Just 11 years. So the paltry yields on safe investments drove investors to riskier assets, thanks to economic growth and plentiful liquidity. From March 2022, it was a complete replay of the post-GFC developments enumerated above, including a quick economic bounce and even a quicker market recovery. It's hard to achieve good returns dependably and safely in a low return world. Yield spreads. Okay, modest perspective returns, I guess, on debt, right, or lower. I'm like getting very tired right now. I need some caffeine, unfortunately. Okay, right. So the relationship between future expected returns and prices, I think, are inverse, right? Because if prices rise, then I think the future expected return declines. I see. So all of the funds that borrowed at really low interest rates, some of the banks or maybe syndications or other private credit firms that made those loans have decided, man, these loans are pretty much worthless relative to the interest rates that I could be making and also the inflation that has settled in, right? Yeah, even after allowing for some defaults, they're likely to deliver equity-like returns sourced from contractual cash flows on public securities. Credit instruments of all times are potentially poised to deliver performance that can help investors accomplish their goals. Okay. So where does the Fed get its money from? I guess from the government to purchase their bonds. Okay, so yeah, his outlook was interesting. So this was back a year and a half ago, and I think so. What exactly happened, right? Inflation today, I think, is probably around the same, if maybe a bit softer compared to what it was back then. And we haven't had a rate cut, I believe, since December 2022, and I think they actually even had a few more rate increases since then. Right. Okay, I'll be back in a sec too. I'm gonna mix myself some coffee. it's the indispensability of risk, the impact of debt. Willingness to take risk, right? Huh. Hmm. Yeah, it's a short, nice memo. Okay, got my tea. Uh, the indispensability of risk, the impact of debt. Okay, so yeah, I think after these two, I might try to summarize some of this stuff. Also, write these down in flashcards. Yeah, I like it. Short and sweet, concise. Collaborative fund, one of my more interesting sources for readings, practical philosophy. Yeah, I feel like I'm reading all this stuff. These are all kind of like, what do you call these? Small nuggets of wisdom that make you just feel good, but doesn't have any big impacts. Although I do think the sea change one was interesting. I guess it does help you frame a way of thinking, right? Oh, it's hot. I hold tons of cash and no debt. So I use a series of simple graphics to show that the lower a company's debt load is, the greater the decline in fortune it can survive. Interesting. Why? I would imagine it to be the opposite. Okay, yeah, that makes sense. Okay, so in all aspects of our lives, we base our decisions on what we think probably will happen. Right, so we just look at history to forecast the future. Fridges penalized, not rewarded. So there, what do you say? So there's that old saying, if there's someone old in the field where young people don't make it, and those people are really wise, something like that, right? So let's see if we can find this SOS thing. Morgan Housel. Let's mark out. I guess this is a venture capital fund, I'd imagine. It's collaborative. Okay, interesting. Folio. Manglo, Brimstone, possible Whoop. I feel like I've heard of the Whoop bands. Daily Harvest. Is that like a... Ooh, they back Kickstarter, so I'd imagine Daily Harvest sounds like one of those delivery food delivery things. Magic Spoon. Oh, this is the cereal. I think the cereal brand. I like the branding on this though, but I'd imagine there's not too much about it. Yeah. So what about, let's take a look at the blog, see if we can see what that... Hey, Richmond. was here last night because I work in Baltimore in the summer.
Ah.
So I was working here this past week.
Okay.
I've just been doing some reading, that's it.
That's it.
You guys gonna barbecue soon?
Yeah. Little gorilla. Yeah. Little gorilla.
What are you guys making?
Some chicken.
Some chicken?
Chicken, burgers. We already got like some rice pre-made and some wings.
Yeah.
Yeah.
Can I have some?
Yeah, you definitely can though. I think my other's up there working right now.
So you guys can help with the...
You said with the grilling?
Yeah, with the grilling or supplies, anything?
I feel like we got everything. We brought most of everything upstairs though.
Okay.
But you definitely, you're more than welcome. Yeah, we about to be. You're more than welcome. Yeah. Was that gonna see some fireworks today?
Probably. Yeah. Are you guys or not?
Probably.
Josh just left like an hour ago. Were you looking for something or not? Oh, okay.
This ice machine is no good. Bro, what do you mean? Yeah, that's not even that. It's just like, it's
You're gonna
a
need-
little crazy.
You're gonna need something else to put it in.
There's an ice machine here.
You don't use it a lot?
Never.
Yeah, but I mean, that's welcome though.
Who sees this?
Yeah, you think it might still, but no, I think you can use that.
We have a lot of ice. You guys want more or not?
Yeah, we probably take this a little bit more.
Oh yeah, that way.
No, I think we might just play here for a little bit, and then we might go out later.
Yeah.
Yeah.
To DC or to...
Yeah, I think I'm going to DC.
Okay.
Yeah, what about you?
I was gonna go back to, I don't know, Westwood usually?
Yeah, I've been before.
My girlfriend lives in Westwood, I was gonna go stay at her place.
Oh, okay. At the family?
No, just us two.
Okay.
Her family's out on vacation, so just us two.
Oh, okay. You took a long time.
So I'm excited.
Did I use this or
Where's the shirt?
This is another cooler?
yeah.
Word. Okay. Yeah, no. Oh yeah, he's burning that. Does this ever run out or?
That's a good question.
Someone was telling me
I didn't have no ice.
Richard, what have you been up to this past month?
Man, I just been chilling. It's like
Joe, have you been grinding up for those job applications or not?
yeah, I have.
Yeah, okay.
Yeah, I'm gonna start grinding some more after this little break.
Yeah.
Yeah.
Any leads, places that you're interested in working at, or?
I mean, like I have a few in mind. I know a few people.
Yeah.
Hitting me with real, you know, like there's one guy with like center, and he has like to connect with, you know, setting over for the recruiter over there, and you know, stuff like that. I'm just kind of open. I had this really, there's one company reached out for like, you know, saying that, oh, like you're one of the people we're interested in, so I'm just kind of waiting to hear back from them too.
Yeah.
Yeah.
I'm gonna start applying for full-time jobs right now, so.
Oh, for real?
I gotta start.
Oh yeah. For the fall too, or just? Oh, okay, for next year.
I'm either gonna look for full-time, maybe some internships if I really wanna stay for a master's or something, but I'll see. Nice.
And if you were to do a master's, what would it be? Like, what would that look like?
I'm not too sure, to be honest.
Okay. Mom was saying that she left everything, bread, potato salad, something like that. Yeah. And then she asked for that. You guys have a knife?
Not too sure.
Sure.
Yeah, I don't really cook, to be honest. Like a classic
Knife, maybe like a. Let's see. Oh, you guys don't have like the.
We have plenty of knives here. Something like this.
Yes. We're gonna bring it back though.
Yeah, no worries. We have a lot.
Yeah. Yep. Put a little grill in.
Yeah.
It's gonna be cool. It's gonna be good time.
You guys have any popsicles or anything? You guys wanna take some of the rocket pops that we had?
You guys have popsicles?
Yeah, these.
My mom loves popsicles, so she definitely.
Oh, yeah.
Oh yeah.
Yeah, well,
I'm gonna take like two.
yeah.
Oh, what you had? Popsicles? Yeah, the popsicles.
Rocket pops?
That's a knife right here. That's it right there? This is it. You can put it on top. Everything? That's everything? The potato salad and stuff is there? Yeah. Alright. Yeah, so, are you gonna come back anytime soon, or?
Yeah, maybe on Monday or Sunday.
Yes. Yeah, I'll see if.
Are you gonna be back here?
Let me see. I'll be on Tuesday to visit.
Yeah.
Yeah. Hey, hold on real quick. Let me grab my. Let me grab my bag. A little bit.
I'm gonna finish up this reading real quick. How long are you guys gonna eat it for?
For a good amount of time though.
Okay.
So yeah, we'll be okay.
Okay, I'll wait till that.
Yeah.
Yeah, I'll see you later.
Yeah, I'll see you. Can say so.
I appreciate it.
What would you want? Like an hour, block?
I'll take a hot dog. Alright, thanks. See ya. Okay, so I had just So my roommate Richmond just came in, and I was just talking to him. But he's having a barbecue upstairs, so I might join him in a little bit. Okay, let me go refill some of this tea real quick. I'll be back. Yeah, dozens of wars, honestly. 500 years. 1500s? Jesus Christ. 1,000 years old. Yeah, it's the year 1000. Kent Nurbin. So debt defines your future, and when your future is defined. Hope begins to die. You know, I agree with this, but I think in the context of investing, sometimes you don't want to invest in just hope, right? Having a clear future when that future is, how should I put it, rosy and colorful and happy, then what hope do you really need at that point from an investing standpoint? If it's defined, all of your uncertainty is gone, and you don't have to worry about anything. So yeah, that's something to think about. I'm not too sure what these things mean. Wars, recessions, terrorist attacks, pandemics, bad political decisions, family emergencies, unforeseen health crises, career transitions, rejoice from other mishaps. Having options and flexibility. I remember somewhere in a reading mentioned that flexibility is synonymous with market timing. I think David Swenson said something about that. Yeah. Yeah, I have to admit, these are pretty fun to read, so. Yeah, this is also one of those feel-good articles where you just talk about thinking, but okay, so I've read through a lot of these different types of blogs and memos, and I want to somehow aggregate all of these thoughts together and maybe read some flashcards, so hopefully I won't forget them. But let's start with sea change, right? So sea change, there's two major sea changes. I'm gonna try to not look at my notes and just go off of memory. First one, you saw that in the 1970s, in the 1970s, you have a period where there's a lot of these high yield investments that were once shunned. So shunned in the sense that a lot of these people, not people, but more so sophisticated investors. Oh, what's good, Allison? But yeah, these sophisticated investors would... So smart. Nah. Let's see. Allison. I'm excited to see you in like 2 hours. So thanks for tuning in though, Allison. I appreciate it. But two things, right? So one, you saw this really big rise in high yield lending in the 1960s, not 1960s, 1970s. Yeah. All right, see ya, Allison. Bye. And then this was really pioneered by Michael Milken. So previously, a lot of institutional investors, maybe the investor world in general, thought that the most prudent investors would shun away from non-investment grade debt. So this is debt that's rated below AAA or single A, triple B. They thought the risk was too great, and they didn't really think about the risk-reward compensation. Risk-reward compensation meaning they didn't think about the extra risk that you would get for taking on an extra bit of return. Extra return that you would get for taking on a bit of risk. Now, that kind of shifted with Michael Milken. He ended up popularizing the idea of junk bond investing. So investing in non-investment grade debt, and in return for taking on this risk of investing in distressed securities or the debt of distressed companies, you received a pretty handsome return. So Howard Marks, this is kind of where he got his investing background in, was a lot of this high yield junk bond investing, and he saw that if you were to think about the risk and return trade-off, you can kind of somehow control the amount of risk that you're taking and earn a return to compensate you for that. So that was kind of the big epiphany, the big sea change, where previously, before the 1970s, a lot of people didn't really think about things in terms of risk and their returns, but more so just thought about risk in itself, isolated from the returns that you would receive. So that was sea change number one. Sea change number two was this long-term decline, this 40-decade decline in interest rates, starting from the early 1980s, all the way up until 2021, maybe mid-2022. So this was really big, and I don't really have too many notes on this, which I want to add a little bit more, but he thinks that this long-term decline in interest rates was one of the biggest drivers in a lot of these alternative assets. So hedge funds, private equity, venture capital, probably those are the three biggest types of asset classes that have benefited from lower interest rates. And then also, I guess you can think of public equity as well as another benefitor of these low interest rate environments. So the underlying idea behind where this benefit lies is the lower interest rates, they allow a lot of these leveraged buyouts to have multiple compounding factors that create a lot of value if the underlying company that is bought out through a leveraged buyout performs well. and the cost of borrowing to purchase that company is less than the actual returns that you would expect. So that's kind of how leverage is used in order to magnify the returns of a leveraged buyout or within any type of finance type setting. It's beneficial for an investor standpoint to use leverage to magnify your return on equity. So that's the two big sea changes. The third sea change that Howard Marks says is in the next 2, 3, however long years, interest rates are starting to go back to their historical levels. So we've seen a period of 40-year long decade decline in interest rates, but now we've seen a 10, or maybe we'll see a 10-year rise in interest rates or a 10-year of elevated interest rates relative to the previous. I'm gonna be back in a second. You guys need more ice or something? Or?
Yeah. This stuff, it was kind of leaking, so.
I see.
Yeah, I just wanna clean this out, man.
I can get some ice for you guys.
By the way, what book are you reading?
Just a few books and then some blog posts. Like a lot of investing books.
Are you familiar with venture capital?
I know about it at a really high level. I don't know too much of the details. Okay, what's up?
Yeah, so there was this company that wanted me to do like an internship for them,
Yeah.
and they were like a venture capital firm. They were doing some very interesting stuff, but I didn't have like enough time to really like dedicate into like the internship, so I was not doing it, But basically, it was an externship,
Yeah.
for like a month and a half,
Yeah.
6 weeks or something like that. But and they wanted to like invest in companies that are trying to get into something called robotics AG, which is like robotics in agriculture,
Okay.
stuff like that.
Yeah.
But yeah, it was an interesting opportunity because I was just like, nah, I'm gonna just cool off on that.
Yeah.
So,
What would they have you do? Would you be trying to look for different companies to buy or to invest in? You would be kind of messaging the CEOs of those companies?
not necessarily messaging the CEOs, but they wanted us to look at like the profit, what was it, the risk investment or something like that. There was something that they used the term, like some venture capital term that something about like look at the risk to profit ratio or something like that.
Interesting.
Okay. Hello? Okay. 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 Is the tonsil in there too? Is the tonsil in there? Is the tonsil in the blue bag? Okay, alright, that's cool. Alright, that's cool. Alright. Alright, that's cool. Okay, alright. Alright, I'll see you. Alright. Yeah. So that was basically it.
Mm.
They wanted us to see which companies are like really worth investing in, you know, and like wouldn't have a high risk value and stuff like that. So yeah.
That sounds hard, because how do you even find out? I imagine those companies are pretty small, so they don't have that as public information.
Matter of fact, I'll just send it to you.
Also, I don't know if there's any more ice.
Oh, for real?
Yeah, I think it's cooking up right now.
Oh, okay, yeah, you can taste it all. Yeah, that's cool. Let me show you. Yeah, let me look into it.
That's okay. You don't have to.
You have to look into that one, but they have basically like these externships with the, some of them are like 3 months. So mine was supposed to be like during the spring, and I think it was like February to like March
Yeah.
20th or something like that.
Mm-hmm.
Yeah, but they were doing some really interesting stuff, and you know, I really wanted to do it, but you know, the time I like, you know, when I was weighing the out, like, you know, weighing the scales with the time I had, and you know, and also you know, we to apply to jobs and stuff like that. I was like, man, we just not even bothering myself, you know. Yeah.
Do you remember what the company was called? The venture capital company? They specialize in the agriculture robotics thing? Or?
So they were partnering with a company like that. There's like there's an industry for externs,
Yeah.
and then there's like another industry for those people that are like the venture capital people.
Oh, okay.
Yeah, so and they were also like, so the extern company, they also had people like who do externships for like beats, you know, not the pure beats, and what was it? Some other company, you know. I'll send it to you.
Sounds good. Alright, I'll see you in like 20 minutes. I'll head up over there.
Oh, yeah. We already have some like some job practice. You ever race some job?
What's that?
You ever race some job practice?
I think so. I think you do at some point.
Oh, bro.
Yeah.
Oh, okay. Yeah, so we have some of that, and we're trying to make some of the burgers and hot dogs and stuff like that.
Alright, I'll come up soon then. Alright, that's it. Hello. Yeah. OK，我可能明天回来，我这些朋友要接我去他的家。Yeah。就是你朋友的家 Clarksburg。Yeah. No, it's not that hard that. Mission. Yeah. Yeah. OK. Yeah. 你们今天要干什么？还是？yeah，你们吃了？我明天吃剩的。OK，但是明天出去吃我也可以。我看了。Yeah. Yeah, I see it. Bye. Okay, so back. So the third potential C change is the rise in interest rates and the outlook of investing going forwards, right? Okay, so let's I'm gonna open up Anki. All right. I don't know why Anki Auto goes to full screen. I don't know how to get out of this too. So, how to get out of full screen Mac. So Command Control F. Oh, there we go. Nice. Okay. So switch profile. Let's go to same fund. Okay. So books, investing, technology, private equity. What do I have here? Okay, interesting. All right. Yeah, maybe it'll be worth going into this and cleaning it up a little bit, but let's go create something. I'm gonna create investing memos, right? Okay, then Howard Marks, create and C change. Okay. Ooh, did not want to do that. Nope. So what author Howard Marks memo C change publication December 2022. Okay. So what are the two C changes? So how does Howard Marks define a C change? What are the two C changes that Howard Marks has seen in his career? The two C changes that Howard Marks has seen in his career can be break. Howard Marks started his career in 1969 and has seen the following two C changes. Okay, so one is the shift from investor psychology in investor psychology from thinking about risk and return separately to thinking about the trade-off between risk returns independently, I don't know, of each other / relationship between risk and return. And then 2 is the 4 decades long period of interest rate decline from early 1980s to 2022, to early 2022, right? The shift from a period of high inflation and high interest to a 4-year, decade-long period of interest rate decline, right? So how are marks defined? Yeah, I would. How does Howard Marks define sea changes? So sea changes are defined as fundamental shifts in how people think, how markets react, how markets work. Maybe of the existing status quo to work, or what the status quo is. As a complete transformation radical change of direction and attitude, goals, etc. Okay. Sea change. Sea change is defined as a complete. Okay. So what was the, according to conventional, to Howard Marks, what was the conventional, so what everyone thought, what was the smart thing to do that everyone would do? So what was the conventional wisdom behind the Nifty 50 1970s. So the Nifty 50 were 50 of the best, of the highest quality stocks that anyone could buy in the 1970s. So I think Xerox, Kodak, plus more, IBM, yeah. The conventional wisdom was that there was no price too high to buy. RIP. Are these names now? No. There's no price too high to buy. All right, okay, so this kind of goes into the, okay. Michael Milken pioneered junk bond investing in the mid-1970s. Challenging the existing status quo that non-investment grade debts should even be considered as a prudent investment. Should not be considered a prudent investment. Okay. So prior to rises in junk bonds, right? Companies could only be acquired by larger firms, so strategic or IPO. Right, so when we think about PE investing today, there's really 5 different exits: selling to a strategic, selling to the public, and then the 3 other types are mainly across different private equity entities. So you could sell to another private equity firm, so sponsor to sponsor. You could sell to the next fund, so fund to fund transactions or cross fund transactions. So that's like Bain Fund 4 sells a company to Bain Fund 5. Or you could set up a continuation vehicle. It's kind of like this special purpose vehicle that will be set up by the general partner to purchase the company from an existing fund. Let's say Bain Fund 4 goes into this SPV created by Bain, and this allows the limited partners to make an exit and new limited partners to invest in it. Yeah, so I guess what this is trying to say is that prior to junk bonds, there's really only 2 options for the exits. You could get acquired by a strategic, or you just sell to the public. But with this, the high yield bonds were able to create a new class of investing, and this is where private equity comes in with their leveraged buyouts. So those that were able to pay with cash on hand or borrow large amounts of money and still retain their investment grade ratings, right? Okay. The underlying, so no one wanted to, so no bank/lender wanted to finance the the acquisition of a company that would cause the buyer to fall below investment grade territory. Okay. Then no one would lend to. Actually, would anyone lend really? Buy their securities. Okay. Yeah, you guys need more ice? I wonder if there's a ice machine here. Let's see, the hub ice machine. Damn, okay, there is no ice machine here. It's unfortunate. Work plus study. Yeah, well, that's unfortunate. Okay, well. Yeah, going back to this. So, high yield bonds. Okay, I think then in this case, would these private equity firms like KKR, would they ask for a loan from, say, JP Morgan, or would they issue some type of bond in order to help finance their transaction? So I'd imagine that's kind of like public debt. Let's see. Are bonds considered public debt? Corporate bonds considered public debt? Okay, yeah. So public versus private debt, I guess the public debt just refers to selling bonds. Okay. So did yes, ChatGPT actually. Can you be my finance historian expert, finance history expert? Was lending to distressed companies common in the 1900s, in the early to mid 1900s? Okay, so Chapter 11 was created in 1938. So this is interesting. Yeah, I didn't know about that. But so did Michael Milken's junk bond era change this? Yields of high yield bonds, commonly known as junk bonds. Right, so how did junk bonds affect the private equity markets? Did a private equity firm like KKR issue bonds to help finance an LBO? Right, so RJ Nabisco, 1989, Michael Milken. Okay. So, do private equity firms today still rely on junk bonds? 2024, 2020s? Or do they rely more on private credit / syndicated loans? Okay, so that's actually pretty eye-opening. So this whole private equity space really started with junk bonds, then I guess over time moved towards syndicated loans, and then now I think the big craze is around private credit. So a lot of these private equity firms actually have their own private credit arm, or maybe some specific or companies that actually focus on private credit itself. I'm thinking of companies like Ares Capital Management. So they have dedicated credit funds in order to do this. Yeah, I think that's all very interesting. Okay. So yeah. So no one, oh man, there's a fly. Okay. Would also, no one would want to buy any bonds that the acquirer would issue to purchase the company, the target. So junk bonds help finance the private equity boom in the what was the first private equity firm fund? Who was the inventor of the leveraged buyout? Yeah. So interesting. What about the buy and build type strategy of a platform company and 15x and adding on smaller companies at 10x, say EV to EBITDA? Clayton, Dubler, and Rice Carlisle Group. Okay. Yeah, I remember, I think this was mentioned by David Swenson in his book, Team Associates. Just gonna pick on this guy. Oh wow, yeah, I mean, these guys are all really smart, it seems like. Let's just see. That's tough. Mechanical engineering. Company. Yeah, these Asian guys, let's see. So everyone here is cracked, it seems like. Man. Oh! We have one guy from University of Maryland. That's tough. Clayton, Delper, and Rice. I'm gonna take a look at what the That's interesting. Okay. Okay, so I really need to actually finish this up. It's almost 4:30, so I gotta go up there and go to the barbecue real quick. 1980s. Firms like KKR would issue junk bonds to help finance its acquisitions. It's leveraged by buyout acquisitions. Yeah. Okay. Okay, so what do I have here, right? What are the 2C changes that marks? Okay, so oops, yeah. Let me also add. So according to Howard Marks, I guess I don't need to add that every time. But one thing I do want to say is, what was the conventional wisdom behind bond markets? Let's take a look. I think this was before the mid 1970s. The conventional wisdom behind bond markets before the mid 1970s. So Howard Marks. So before the mid 1970s, or how did fiduciaries, so I think pensions and endowments, invest in bond markets? Conventional wisdom with prudent investors was to avoid non-investment grade bonds like the plague. Okay. Right. Investors did not think about securities securities risk/return profile. But only focused on the avoidance of risk. So I could kind of see some of the merits behind that, but also some of the downfalls as well, right? Okay. right, so fiduciaries. Alright. Okay, nice. We're restricted from investing in these junk securities. So companies that were highly distressed had no demand for their public debts. Right. So how did the rise of junk bonds, pioneered by Michael Milken, influence the private equity business market in the 1970s? I guess, yeah, what was the first ever LBO? Okay, nice. Junk bonds and their adoption by mainstream institutional investors led to the rise of LBOs, pioneered in the 1970s and 1980s. Previously, investors shunned the idea of purchasing highly distressed debts, no matter the return, but Howard Marks noted that a big sea change took place as investors started to shift psychologically to a risk/return focus on risk and return trade-offs. So junk bonds provided the much needed access to financing from private equity firms like KKR that bought distressed companies or companies that were operating but decided to leverage them up. Which whose public debts carried lots of risk, but also higher returns. Okay. Gösterişini provide the much needed access to financing that bought distressed companies. Create lots of risk, but also high returns. Okay. So maybe one thing to note is how has financing shifted? Let's see. So how has private equity financing shifted the past, say, so 1970, that's about 50 to 60 years. So first, junk bonds to syndicated loans to private credit. Okay, yep. All right, so with that, I think I'm probably going to end this here. Yeah, I'm going to end this here. I'm going to go take a look at this barbecue upstairs. And then now I'm going to head out to... Yeah, and then I'm going to head back home. So thanks for tuning in. Catch you guys in the next one. Peace.